Hi everyone. So you can't ignore all the headline news and chatter about inflation in the last few weeks. This month's CPI or Consumer Price Index report from the US Bureau of Labor Statistics spooked a lot of people. Are we going to experience massive inflation or even hyperinflation? And should I be worried about it? This is a question we've received a lot from our clients. So we thought we'd address this topic in today's Investor Questions segment. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. Okay, let's jump right into this then. Let's begin by defining inflation and hyperinflation. Inflation in simple terms is when the price of goods and services increases over time and lowers your purchasing power. This definition has evolved over time, and for many economists, this negates one of the most important aspects of inflation, and that's the money supply. Governments, or the Federal Reserve, as is the case here in the United States, has the ability to print more dollars and to distribute those dollars directly to its citizens, financial institutions, or businesses. The imbalance between the quantity of money and trade needs can also be the reason for price increases or inflation. This imbalance occurs when there's not a corresponding growth in output of goods and services with such an increase in the money supply. More on this later. Hyperinflation is the exponential increase in the price of goods and services, where you could see a 50% increase or more in the price of goods and services every month over a particular period of time. This dramatically erodes the real value of the local currency and is devastating to the country's economy and its citizens at large. Notable examples of hyperinflation occurred with the Weimar Republic of Germany following World War I in 1922. Here, the German government underwent heavy money printing to try and relieve itself of the immense levels of government debt, while at the same time saw massive reductions in manufacturing and production outputs. Hungary in 1945, devastated by the effects of the Second World War, caused its government to print money in the attempt to prop up the nation's businesses and economy, but fell victim to hyperinflation, where at its height saw inflation doubling every 15 hours. In 1992, in the country of Yugoslavia, afflicted with the effects of war between the breakdown of the Soviet Union and corresponding conflict with Bosnia and Croatia, caused a dramatic decline in productivity, coupled with a trade embargo by the United Nations, incentivized the Yugoslavian government to turn on the money printers and again became victims of massive hyperinflation. In 2007, Zimbabwe's government and its poor political and economic policies caused a massive withdrawal of foreign investment and capital, driving its local currency into a downward spiral, which caused the price of farming equipment and supplies imported to skyrocket, crippling the nation's most important industry. The government again saw no other way out but to turn on the money printers and increase the money supply, but to no avail. In 2009, North Korea was hit with hyperinflation caused by farming sanctions and weather events, which forced the government to combat lower production and economic collapse through money printing. And finally, the most recent example in 2016 with the country of Venezuela. Political instability combined with international sanctions forced the government to increase the money supply in an attempt to keep their economy afloat and to maintain its standard of living. The combination of money printing and a dramatic decrease in manufacturing and productivity output created massive hyperinflation, devastating the economy, which is still struggling today. What's fascinating about all of these examples is that we can identify some common trends that link all of these scenarios together. In each case, there was 1, a destabilizing event that occurred within the nation. 2, a steep decline in productive capacity, crippling the economy, which in turn creates number 3, which causes the government to implement dramatic stimulative measures, such as turning on the money printing machines and increasing the money supply. Sadly, in all of these cases, the result of these measures created some kind of failed state. So let's turn to our own borders here in the United States. 2020 saw a global destabilizing event with the COVID-19 pandemic, which caused the global economy to shut down for a period of time, shutting down supply chains everywhere and reducing productivity output dramatically for some industries. The US Federal Reserve acted quickly, reducing interest rates to zero, and started printing money and distributing money directly to the consumer through the form of stimulus checks. In the great financial recession of 2008 and 9, the government did the same thing. With its quantitative easing program of bond buying, the Federal Reserve injected new capital into the financial system by providing massive amounts of liquidity to financial markets. Many economists thought this would give rise to massive amounts of inflation, but because of the slowdown the recession caused in the economy, prices actually fell, and we saw a period of deflation for a period of time, which ended quickly by the end of 2009. The Federal Reserve's goal was to keep inflation at around 2%, which if you look back at the last 12 years, it's been able to achieve this on aggregate. Now let's look at today. As you can see from this chart, when we zoom out even further to include last year's stimulus and money printing, it dwarfs what the Federal Reserve did back in 2008 and 9. In fact, the US has printed more than a third of the active money supply in the economy today within the last 12 months. Think on that. Okay, so the Fed has printed a whole bunch of money and distributed that to the American people. Isn't that a good thing? What's the big deal? Well, on the surface, it seems that the government has helped the poor and middle class with stimulus checks, which in turn has been consumed by buying goods and services. It's helped to pay the rent, food, and other necessities of life. But it's also been used to pay down debt, invested in the stock market, cryptocurrencies, commodities, collectibles, which in our opinion has given rise to a lot of speculation and asset bubbles. But that's what makes up our economy, right? We all have a choice on how to best allocate our resources. But with all the money printing from the Federal Reserve, it's created a tax on all of us, regardless of your wealth status. This is an inflation tax. The Federal Reserve can print all the money at once, but that just increases the money supply. It does not print products, goods, and services. There are three kinds of inflation tax that we can identify. 1, demand pull inflation. 2, cost pull inflation. And 3, built-in inflation. Demand pull inflation is when there's an increase in the money supply, causes demand for goods and services to spike more than an economy's production capacity. This causes prices to rise. In our opinion, this is what we're seeing in the housing market. Due to the COVID-19 pandemic, the ability to work remotely, coupled with the onset of new first-time home buying from millennials, you're seeing a huge demand spike for housing, but the supply is not there, and so you're seeing a dramatic rise in house prices nationally. Cost-push inflation is derived from the channeling of money printing into the prices of commodities. This commodity inflation works its way into the cost of goods, which raises the prices of our finished goods, which we purchase and consume. We see this, for example, in the price of oil. When oil prices go up, this raises the cost of transportation, and doing business and consumer prices go up. And then, of course, we're seeing that right now with lumber prices, which over the last year have increased over 250%. The third type of inflation is built-in inflation. And this kind of inflation is akin to adaptive expectations, where the general public at large believes that prices will go up due to inflation. And because of that, the workforce of the economy demands wage increases to maintain its standard of living because of these long-term, consistent price increases. Increased wages result in higher cost of goods and services, and this wage price spiral continues as one factor induces another, and vice versa. We're also seeing that right now, where big corporations are raising wages to incentivize and attract new employees. This could make it difficult for small business, but perhaps will cause an effect where small businesses will seek to invest more in technology and to find more efficient ways to replace costly labor. This chart is from the US Bureau of Labor Statistics and shows the inflation rate on a monthly basis going back 3 years. You can see the years prior to February of 2020 that we were tracking that 2% inflation rate, and then notice the drop-off during the height of the pandemic, and then the rising inflation in the last 3 months, where the last month's reading was above 4%. When you take a look at this month's CPI report and drill down into the specifics, we find some interesting highlights. This is the table that shows CPI for all urban consumers across the US, looking at the city average detailed by expenditures. Notice the categories that significantly influence the CPI report. Used cars and trucks were up 10%. Lodging away from home was up 7.6% and 8.8%. Car and truck rentals were up over 16%. Airline fares up over 10%. And admission to sporting events over 10%. All other categories seem to be in line with overall inflation rates, but these categories mentioned really were the factors that raised the overall inflation rate to over 4%. One would think that as our economy opens up fully and the consumer starts spending more of their dollars on experiences versus goods, that overall inflation might come down in the long term. But the future is uncertain, and inflation is one of the hardest economic indicators to predict, as there are so many factors and variables that influence this important measure, which also has a bearing on markets, valuation, and interest rates. These categories that were up so much this past month were affected the most during the height of the pandemic. And now you have rental car companies buying up used cars to replenish their fleets, which quickly sold off last year. You combine this with a chip shortage, and you're really seeing a bottleneck in short supply with regards to this area of the economy. Airlines, lodging, and hotels are charging more because the demand for travel is increasing as more citizens become vaccinated. So all of this makes sense. The big question is, will we see sustained and higher rates of inflation? And no one really knows. What we do know is that inflation is ticking higher right now. So what does that mean for those investors choosing to remain invested in cash and short-term money market funds? Well, as we've mentioned in previous videos, you're almost certain to lose purchasing power remaining in cash, especially as the dollar continues to be devalued through the increase in the money supply and with rising inflation. In a rising inflationary environment, you want the majority of your long-term wealth invested in inflation-adjusting assets. Many advisors out there will recommend investing your assets into tangible assets like gold, real estate, cryptocurrencies, and TIPS, otherwise known as Treasury inflation-protected securities. And while these asset classes could potentially be good hedges against inflation, nothing is certain or guaranteed. Remember, past performance is no guarantee of future results. And since we don't know what the future holds, or whether many of the events of today will ultimately be positive or negative, we think the best approach here at YCG to beat inflation and to potentially grow your wealth in the long run is to own a collection of global champions with enduring pricing power that have long-term volume growth opportunities, are ownership-minded management teams, and have conservative balance sheets that are diversified along the dimensions of product, industry, geography, macroeconomic factors, and market psychology. We believe these traits help our companies to participate in the upside of global growth while also reducing the risks of technological disruption, political and demographic turmoil, macroeconomic surprises, and market psychology changes. We would also highlight that our desire for resilience is one of the reasons we focus our investment assets on equity ownership interests in businesses. In our opinion, we believe these ownership interests in stocks are the most resilient asset class in the world. And we believe one of the main reasons for this resilience is that business equity ownership uniquely benefits from the ability of people to adapt to changing circumstances. If you own a piece of real estate and people decide to move away from it, you're out of luck. Similarly, if you own a long-term government bond and government policy leads to inflation or even hyperinflation, you'll lose purchasing power in real terms. If you own the equity of a business, however, you're in a completely different position. A business, after all, is nothing more than a group of people acting in concert to create products and services that the world wants. And as we know, people are adaptable and innovative. Therefore, as the world changes, a properly incentivized group of people can defend against or even benefit from the changing times by creating new products, routes to market, cash management solutions, and so on. This ability to harness human creativity and industry gives businesses incredible resilience to both upside and downside surprises, from which you, as an equity owner, get to benefit. Another added bonus for owning high-quality multinational businesses through stock ownership is that you're diversified geographically and own cash-producing assets, which should generate revenues and excess cash to shareholders in multiple different currencies, which serves as an indirect hedge against currency devaluation if a government chooses to increase the money supply dramatically. Coming back to our original investor question, should you be worried about inflation? Many economists and policymakers agree that the risk of inflation is low. In March of this year, 2021, Fed Chairman Jerome Powell testified to Congress that deflationary pressure over the last 25 years has been strong, and that he thinks that, quote, a one-time surge in spending leading to temporary price increases would not disrupt that, close quote. Something to keep in mind is the technological innovation that we're witnessing in our modern era. With advancements in technology making so many things in our society cheaper, faster, and more efficient, the second machine age that we appear to be well into is a strong argument that could support the Fed's conclusion about having sustained deflationary pressure and keeping any kind of excessive inflation in check. Just look at the technology in your smartphone, for example. This chart shows you back in the early 80s, the technology we now take for granted with our smartphones would have cost in present value terms about $900,000. But due to technological advancements and innovation, driving the cost of such tech downwards to the point where for a few $100s, we have access to all of this software and hardware for free. At the end of the day, investing is all about what you own in your portfolio. At YCG, we invest from a bottom-up perspective and find huge opportunities actively managing and monitoring our client portfolios. Yes, we should be aware of the macroeconomic factors like inflation, but owning a collection of global champions with enduring pricing power and that possess the ability to adapt and adjust to rising prices, in our opinion, is the key. Thanks for the great question today. Check out our other videos and we'll see you next time.